Hi everyone, I'm here today with Virginie Maisonneuve, our Global CIO Equity. Virginie, what do you see as the key points in the coming months for the global markets?
Oh, thank you for your question, and I'm delighted to be here. Thank you. So the key issue over the coming months for both equities and the broader global economic picture, in my view, is divergence. For various reasons, including the strength and nature of support packages during COVID, we are seeing economic divergence between various economies around the world. For example, the US and Japan show strength and resilience, while Europe and China show a much softer growth environment. In the case of Japan, the economy, after years of deflation, is somehow benefiting from inflation, and we are seeing a strong growth rebound due to pent-up demand from all those years and a strong savings base. In Europe, much of the support during COVID was also used to deal with the energy crisis linked to the events in Ukraine. And the core inflation picture is also looking more sticky than in the US. In the US, for example, the injection of liquidity to support the economy during the COVID crisis was equivalent to 18% of GDP. That's very, very large. And 2 trillion of that went to households. A further area of divergence developing with regards to the growth trajectory, monetary policy, and inflation is between China and the rest of the world. In contrast to many economies, China is now in loosening mode, unlike tightening mode to rein in inflation in other countries. That's because China faces several economic headwinds. The Chinese leaders are steering the Chinese economy to navigate both the cyclical softering post the initial COVID lockdown rebound and the structural one. The structural one is to develop a path to enable quality and sustainable growth in an aging economy without the recourse to more debt. If you want, transforming the demographic dividend that China had into a capital dividend. So increasing the added value and basically using more widely all those bright engineers that they formed that are in the economy today. In fact, it is crucial for policymakers to manage the transition from a debt and property-driven economy to one that is more mature and innovation-led. Implementing this transition will play to China's strength, focusing on industries such as renewable, EV, electric vehicles, and computer hardware, as well as infrastructure in the area of telecommunication and tech. The country is already enjoying success. If you take the EV supply chain, basically, it is from end to end in China. Quite amazing in such a rapid period of time.
Thank you, Virginie. Unsurprisingly, the question at the top of a lot of minds is the cost of debt and the cost of money. How do you see this playing out?
So clearly, with 18 months into the tightening of monetary policy in the US and about 12 months for Europe, interest rates have gone up a lot. 400 bips about for Europe and 500 for the US. So the cost of debt clearly has been increasing rapidly over the past month. But the impact of this and will continue to be uneven. Let me explain why. For example, recent corporate default debts have remained low at around 3% due to the resilience of profits that we're seeing, especially in America, and the fixed rate debt that some of those corporations have taken on. Around 75% of non-financial debt in the US and Europe is actually on fixed rates. So some companies are actually benefiting from that, placing the cash that they have onto fixed deposits at a higher level than they're paying their debt at. A recent estimate by The Economist suggests that at current debt level, each percentage points rise in rates wipes out about 4% of the combined earnings of the S&P 500 firms. Well, this is not insignificant, but it suggests that the rising cost of debt is perhaps taking less of a toll on the corporate world than many have feared. Turning to governments, however, we see that this might be possibly having more of a severe impact on the rising cost of debt. For instance, in the US, we predict that net interest costs will reach a high in 2030 relative to the size of the economy. Therefore, we believe that the pain of increasing borrowing is currently mainly felt by governments around the world and policymakers, while the corporate world is so far performing relatively well. Although we should note that there could be a big difference between large cap companies who can access the bond market and a lot of financing versus small cap companies who may not have that kind of flexibility.
Thank you. So given these developments, what would your message be to investors over the coming months?
So the key metric for investors over the coming months is inflation, as this will guide central banks and governments and will continue to guide them. Of course, there's been the big question of the pivots, right? When are the central bank pivoting? Indeed, we have seen some disinflationary trends supporting factors for this may be beginning to disappear. And the impact of weather events such as El Nino, as well as geopolitical factors on food and energy supplies, is yet to be seen. Take the oil price, for example. June 22 average oil price, $115 a barrel. June 23, $75 a barrel. So the disinflationary impact of energy has played a relatively big role, along with the global supply chain loosening, etc. But this is important. So what the oil price and food prices do at this stage will have a big impact on the further deceleration of inflation. Alongside inflation, job numbers should also be very much observed. Given the importance of services in most developed economies, cost of labor will be crucial. In the US, 70 to 80% of cost for the economy is labor, because such a high percentage of the GDP comes from the service economy. And in fact, in the US, in July, job openings fell to 8.8 million, which is the lowest since March 21. This points to a general easing in labor market conditions, albeit a slow one, with respect to potential inflation. In terms of economy growth, we are tilted towards a relatively mild contraction in Europe and a flat environment in the US. In China, we expect a range of broad policy initiatives to support the transition of the economy and support it in this cyclical stage. One further unknown is the US election, and of course, the impact that it might have. The legal perils faced by the leading Republican candidate, for example, are something that we must watch. Market sentiment will certainly be impacted by views on likely outcome by the November 24 election. And we should also expect a lot of noise around China. As economies and companies embark on divergent paths, being selective and attentive to disruptive pressure points will be key to investors. To be vigilant with regards to earnings, be very focused on earnings, pressure points, pricing power, and specifically around cost of debt. But how do you structure your portfolio? Clearly, the anticipation of recession has been there, and so far the economies have been quite resilient. So we think it's very important to have a very carefully constructed portfolio at the base of the pyramid, very diversified strategies such as best style, global strategy or regional strategy. On top of that, quality across growth as a style, value as a style, income, given the role of interest rates. Now you want some income in your portfolios. And at the top of the pyramid, your key themes, areas that you really believe are going to play a major role in earnings development over the next 10 to 15 years, climate transition, artificial intelligence, cybersecurity, food security, etc. So I think if we have this kind of portfolio, we'll be well positioned to take any volatility that might come our way.
Thank you, Virginie. Insightful as always. And thank you for joining us.
Thank you.